Okay, first of all, thanks for the kind invitation to come here to speak. And I guess Richard and I are the only speakers here who have not been pupils of Gary Becker. The first time I met him, that was in 1968-69, when I was visiting professor at Columbia. That was an interesting year because you had this student unrest. At that time, at Columbia University, we had lunch together in the faculty club nearly every day, and that was a really stimulating atmosphere. And what I noticed about Gary was that if we started a debate with different positions, it always ended in either the case that we finally agreed, or that we could define where the difference in assumptions or analysis were that created different views. So it was always clarifying. Sometimes when you discuss with other people, you are uncertain at the end why you had different views. But in discussions with Gary, that was clarified very evidently. Well, I'm going to talk about a paper which I'm just been writing with a colleague of mine, Mats Persson, and you see the name of the paper. The background is really the following. If we go a century back in time, it was obvious that individuals could not survive without either working or getting support from the family. And it was rather natural then that parents were very anxious to install norms among their children that said you should be able to support yourself and not live on grants from others. Also, there were institutions at that time that boosted this norm building among individuals. The school, the church, and the military tried to install discipline among people to be able to support themselves. Then half a century ago came the welfare state, particularly in 1930s, 40s, and 50s. And that meant that individuals could support themselves, could survive without work if they had unfortunate outcomes of health, unemployment, old age, etc. And this income insurance effect of the welfare state is, in my view, a major social innovation with strong positive effects on individuals' welfare. Actually, in some of my writings, I even characterized the modern welfare state as a triumph for Western civilization, and I still stick to that view. The problem is, of course, like in all types of insurance, that you have a number of mechanisms that may undermine the incentive structure, either because of the implicit tax rates in income insurance, or because of temptations to overuse the system, to redefine individually your rights so that you start to exploit the systems, that you live on benefits even if you are able to work. And to begin with, these effects seem to have been very modest. But gradually they were building up and the reason why they were modest was presumably, to some extent at least, the norms inherited from the past, which when you lived in a society without such income insurance system. That means that a clash started to exist between inherited norms and the new incentive systems or the new disincentive systems. Some entrepreneurial individuals started to make very liberal definitions of what it meant to be sick, or to also to if they are unemployed, that they did not search very effectively, but they relied on unemployment benefits. This paper deals with the conflicts or interactions between the incentive structure and the temptations to moral hazard in insurance and norms. More specifically, we ask four questions in this paper. First, what are the mechanisms by which norms may mitigate disincentive effects of income insurance? Secondly, what is the optimum insurance contract in a society with norms relative to a society without such norms? Third, how does the strength of the norms influence the optimum contracts in society with income insurance? And fourth, are norms in these fields welfare enhancing, or rather, under what conditions are they increasing individuals' welfare? There is an emerging literature on social norms, how they influence and interact with income insurance, both the theoretical literature and empirical literature. It's rather small literature so far. In the empirical literature, for instance, it has been able to show that individuals are influenced by the behavior towards income insurance in their neighborhoods, which is presumably the mechanism by which social norms are enforced through neighbors, workmates on a micro level in the economic system. These questions have not been dealt with so far in the literature on income insurance. And to deal with them, it is necessary to clarify first what type of behavior that the norms refer to. And second, what information does norm enforcers have about individuals' behavior? Without having information about their behavior, it is very difficult to enforce any norms. This means, in more generally speaking, that we study in the paper the interaction between norms and economic incentives in a situation with limited information among the norm enforcers. So another way to say it more generally, that we study basic mechanisms in sociology and economics simultaneously, norms from sociology, economic incentives from economics. And I think these ambitions in the paper are certainly in the spirit of Gary Becker. Formally, our analysis refers to sick pay insurance, the compensation when you are sick, which is a very important type of income insurance on the European continent and in Scandinavian countries. But the same principle holds for other types of income insurance, such as permanent disability and unemployment. The analytical framework we use here is an insurance model that Mats Persson and I published 1 year ago, where we treated the individual's ability to work as a continuous stochastic variable. And the typical feature of these models, this means that the model is in contrast with the traditional model developed by Diamond and Merlis, where the individual's ability to work is a dichotomous variable. You're either able to work or not able to work. We treat individuals' ability to work as a continuous stochastic variable, as I said. And you'll see that that makes a big difference. And when we then introduce norms that is in this insurance model that we published last year. So what is the characteristics of that model? Well, it consists, it's a very simple model, but I don't feel ashamed about simplicity. It consists of 5 components. Here you have the utility when working, where the wage is standardized to 1. P is the premium you pay, and B, the benefit you get. Theta, which was the stochastic continuous variable, can be positive or negative. You might enjoy the job per se, or you might dislike it more or less. The second component is a cut-off point below which you prefer to live on benefits and above which you prefer to work, and that you get that, of course, by equalizing the 2 first rows. Then you have a budget restriction for the insurer, where on the left side you have the number of people who work times the premium they pay, and to the left and to the right you have the number of people living benefits times the benefit levels. The F is, of course, the distribution function for theta. And then you have an expression for expected utility. First, for the group who works, and then those who live on benefit. And then the next step to ask, what is the optimum insurance contract, which is a contract in P and B? We maximize the expected utility function with the budget constraint. We get 4 basic conclusions of this. The first one is trivial and very well known, that the optimal contract implies less than full insurance. And that's, of course, to offset the tax wedges and moral hazard. In this model, you have 2 rationales for insurance: income smoothing and pain relief. The Diamond-Merlis model has income smoothing, but we get pain relief in the sense that the individual can choose to adjust if he should work or not in a continuous fashion in the dimension of the pain he feels of work, which is expressed by theta when that is negative. Concavity of consumption utility is not sufficient for insurance to be warranted. By contrast, for instance, to Diamond-Merlis model, you need some additional conditions. Intuitively, they imply something rather trivial, namely that the marginal utility of income smoothing and pain relief should be the same as the marginal utility of consumption that you have to give up when labor supply is reduced when you have such an insurance system. The fourth conclusion is that the tax wedge will reduce labor supply also in the optimum insurance contract, by contrast to the Diamond-Merlis approach, where all where in equilibrium, in optimum contract, all individuals who are able to work do so, and all individuals who are unable live on benefits. Then the next question is, and that is the question of the paper, what are alternative ways of introducing norms in our continuous insurance model. And we make a distinction between what we call naive norms, blunt norms, and norms against cheating. And I'm going to talk about the consequences of putting the norms in different ways. So the naive norm is simply to put a phi expressing the disutility or what you could say stigmatization of living on benefits. And why should we use such a formulation? One is that there is an empirical literature indicating that people are suffering from living on benefits, that there is a stigmatization. Another reason is that the small literature in the field which are introducing the norm in this way, and I did it myself also when I started in the field in 1995. Then the cut-off point just changed a little through phi, and the same with the, you have the same budget restriction, and you just expected utility look about the same, though a phi is slipping in here and there. What we did then is to maximize expected utility in a standard way. And we expect, what did we expect? Well, to begin with, we expected that individuals' utility would increase by a norm, because with a norm, the tax base will be larger in the system because fewer people will stop working. But after some thinking, we said, that's probably wrong. You would get a trade-off between a better insurance arrangement and the direct utility loss for people who are stigmatized. But to our surprise, if you use the symbol L for expected utility with an optimum insurance contract, that turns out to be unambiguously negative. In other words, a norm that is introduced in this way, it reduces expected utility of individuals. So what we had to do is to try to invent a new intuition. It is like Groucho Marx. He said, I have a strong principle, and if you don't like it, I have another one. And we have to do the same thing here with intuition. If the intuition did not conform with the mathematics, we have to make a new intuition. And after a while, we found it, namely the following. If you introduce a norm against living on benefits, that's a direct utility loss, ceteris paribus. And as a result, people's labor supply increases. That's easy to understand, and it follows from the algebra. And when labor supply increases, then the tax base for the insurance system goes up, or if it's a private insurance system, it goes up in that case too. And that mitigates the disutility of being stigmatized. But the indirect effect cannot dominate over the direct effect, because the indirect effect only occurs because of the negative effect of labor supply, the direct effect. It's the same logic as in the Keynesian ISLM model. If you increase government spending, national income or output goes up, and then people's demand for transaction balances goes up, and interest rates goes up. That counteracts the direct effect. But it cannot dominate over the direct effect, because the interest rate increase only occurs as a result of increased GDP. And that's the same mechanism here. Well, what this shows is, as we often find, that intuition is important, but it is somewhat flexible. Sometimes too flexible, but not in this case. So next question is, how should we instead then introduce norm in this model to make it more, to make more sense and to see if the norm could not do some service here? We start then with what we call a blunt norm. A blunt norm, that's based on the assumption that the norm enforcers, neighbors or workmates, can only observe one thing, namely if you go to your work or not. And if they go to the work, they get the utility of the first line. But they cannot observe if the individual instead simply stays home and producing utility for himself, painting the house or whatever it is. And then we assume that the returns to that is W, which is usually smaller than the wage rate, because you are less productive in the homework than in your profession. Or the third alternative, that an individual cheats so that he gets a B, the benefit, but he also works in the shadow economy or in the household. In other words, in the non-regular part of the economy, and he gets a double income, W plus B. Or if he lives on benefits. So the assumption is here that three last alternatives are identical from an informational point of view to the norm enforcers. He cannot distinguish between these alternatives. And that's why we call it a blunt norm, which, so to speak, have this collateral damage. You would like to punish the third people who live on the third level there, the cheaters. But if norm enforcers cannot observe who get benefits without cheating, or home workers or people working in the informal sector without getting benefits. If you make the same maximization analysis here as in the case of the naive norm, you find an undetermined sign. For some combinations of alpha and W, the norm increases welfare, and for others it has negative effects. So we make numerical simulations where we take a large number of combinations of alpha and W. In other words, between this utility of working in the informal sector and the return of this sector. And we use a utility function with CRA, and we assume that theta is normally distributed. And we, as I said, I'm not going to torture you with a table over all this combination. I just want to say that there is a pattern. You see that for high values of alpha, in other words, high disutility of work in the informal sector, if that is high, then you don't need a very strong norm, perhaps no norm at all, because the alternative to working in the market is not so good. You also find that for stronger W, then it's very tempting to work in the informal sector. And then you need a stronger norm. So you get variations of the norm across different combinations of alpha and W. But then, to get some feeling for the working of this model, we make a number of exercises with one specific parameterization, namely when alpha is 0.6 and W 0.3, and we could have taken practically any other combinations, the results in many respects are very similar. So what you get here is the following. If the norm is weak, if you don't have any norm at all, you have lots of people cheating. You have some part of the population working, some living honest on benefits, and one group of cheating. And when the norm becomes stronger, the phi becomes higher, gradually cheaters will be fewer and fewer. It's also interesting to see how the optimum contract is influenced by alternative strengths of the norm. And that simulation looks as follows. If you have very weak norms, you have a rather lousy income insurance system. You have to pay considerable contributions, and the benefits you don't get are not so high. If you increase the norm, you get a better and better income insurance system. And a paternalistic dictator might say, that's fine, I want the citizens to have very good insurance. But a utilitarian economist would instead say, what are the consequences of a sharp norm for utility, and not just for the generosity of the insurance system? And that looks like this. For many combinations of alpha and W, if you have, you see it here that to begin with, a stronger norm increases expected utility in the optimum contract. And that intuitive interpretation is that you get that the advantage of a more generous insurance system dominates over the disutility of being stigmatized when the norm is stronger. And then you need to get the peak there, optimum phi, you might say. After that, you instead come into the situation where the stigmatization, disadvantage of being stigmatized, dominate over the advantage of having a more generous insurance system. In the right part of the diagram, you are in fact back to the naive model I talked about earlier, with the negative relation between expected utility and norms. That was the blunt norm. Conclusions. A non-zero norm term is optimal for quite a number of parameter configurations. And this holds, although the norm is blunt, in the sense that it, so to speak, create collateral damage, because it damages not only cheaters, but also people living honestly on benefits and people who just do not participate in the regular labor market. So then we shift to another alternative. Now we assume very well-informed norm enforcers. So we assume now that they can see if individuals, if neighbors, for instance, get both benefits and work in the informal sector. We call that cheaters. And what is the consequences of the optimum insurance contract in this situation? Well, we make the same type of simulations that from the algebra, as in the case of the blunt norm, there were combinations of alpha and W that made a norm welfare improving, but there were also combinations that gave higher utility without having a norm. But in the case of this rather precise, sharp norm, the usual situation was that a norm was welfare increasing, except in a number of limited alternatives. Then we make the same simulations as with a blunt norm. And when you look at the diagrams for the relations between the strength of the norm and the individual's choice of alternative, either working in the formal sector, cheating, or living on benefits, that looks about the same as for the blunt norm. And the same holds for the optimum PB vector. That is related to the norm in the same way as in the blunt norm. The main difference is in terms of expected utility. It looks like this. There is here no unique maximum, but when the norm is increased, welfare increases gradually up to a limit, and then the norm becomes stronger after this phi optimum point. Then a strength of the further increase in the strength of the norm has no effect, and the reason is simply that at that point all cheaters have been eliminated. So that's why we get a plateau here rather than a unique maximum. It is a little surprising if you think about it, why norms would not be best for all combinations of alpha and W when the norm is so precise. The norm only harms cheaters. Shouldn't that be just fine when it doesn't harm anybody else? And the explanation is somewhat complex. It is that in some cases, norms would harm people because namely for individuals with very low alpha, in other words, with very little disutility of work in the informal sector, or with very high W, very high return. That's very favorable for them if there is no norm that prevents them from working in the informal sector that gives little disutility but much income. And this is the reason why for alpha and W of that, with those characteristics, are unfavorable for the introduction of a norm. So that means that you should allow people to cheat because of very favorable values for alpha and W. But to allow people to cheat, that violates another norm, namely, thou shalt not cheat with benefits. And which principle should we adhere to in this case? That's really an open question. Utility maximization implies that some people should be allowed to cheat, namely those with low alpha and high W. But why should cheating be allowed? Why shouldn't the norm be so strong so that all cheaters disappear? This is a dilemma. I really don't know the answer. It is simply a conflict between an ethical principle and utility maximization. And that is just about, I noticed that there is one reflection at the end there. Perhaps the conflict is resolved in reality by distinguishing between different types of work in the non-traditional sector, for instance, in the household. Maybe people simply say, we should allow people to brush their teeth, even if that is production, household production, and clean their houses and wash in the morning, but not to rebuild their house or to run into informal sector outside the household. So maybe individuals spontaneously adjust their norms to what type of activities, in addition to benefits, should be allowed, and what type of activities should not be allowed and be fighted by stigmatization. Let's see if there is anything more. Yeah, that's just what I said. So it must be true. Some activities are allowed to be combined with benefits without being regarded as cheating. That's the end.
I think it's really fascinating that you're looking at the informal sector in this way. And I wonder whether there are differences by gender for men and women in terms of what is considered cheating. Because to the extent that women often work more in the household sector and that they often get paid by their husbands or their boyfriends, there is really a very fine line, and they could even get paid by their children if they babysit, or by their parents if they take care of the parents. So there's a really fine line between working informally for family members and for people outside the family. So how do you distinguish between, I imagine that the range of norms regarding work in the informal sector and what is considered cheating is going to be very fluid, and is going to vary a lot according to the country and what kind of families they have. Is it South Korea or Sweden or the US?
Yeah. If you're right, wouldn't that imply then that we should discriminate more against men who work in the informal sector than females? Is that the? We would expect that people would do that to stigmatize men in the informal sector more than females.
Yeah, I would think that due to the informal norms regarding household production of men and women, that there may be a difference in terms of what's considered cheating for men and women.
Another reflection is, of course, that different countries have inherited differently strong norms. Maybe in the Scandinavian countries with Lutheranism, etc., the norms were very high for a long time. So we could build up very generous welfare states without destroying economic incentives. Or you can say it takes longer time. Time lag is longer in the Nordic countries before we get serious problems, but we certainly have them. Norway and Sweden have, according to health indexes, the best health conditions in the world, but they have the highest absenteeism from jobs for certain health reasons.
Yes.
So it seems that the problem is there.
Assar, thank you very much. This has been very informative.